for the crucial question, is Visa fairly valued at current prices? To answer this properly, I believe we should look at some of the key financial metrics. All right, so let's look at Visa's financials. So first one on the list is revenue. So if we're looking at overall revenue and annually, they're, as you can see from the trend line, they're growing at an impressive rate. Visa is growing at a 14% revenue growth, which beats the market's 5 to 7% average, showing a strong business momentum. It's really important to look at their revenue, and which is quite impressive. And another thing I believe we should be looking at is earnings per share. So, which is even better because their 23% EPS growth significantly outpaces revenue, proving operating leverage is working. This efficiency creates the compounding effect that we want to see. More importantly, the value-added services grew 26%, showing Visa's strategic shift to higher margin revenue streams. This isn't just growth, it's higher quality growth that sustains Visa's exceptional profitability long term. Other things that we should be looking at is within cash flow. So one of them is their operating cash flow. As we can see, the cash flow is growing 31% faster than revenue. That's what we call improving cash conversion, and it's a huge positive. Many companies report good earnings but struggle to turn these into actual cash. Visa does the opposite. Their business model is exceptionally efficient at converting revenue into cash. So after taking out the small slice from the capital expenditures, we get free cash flow, which is another important metric to look at. So as you can see, their cash flow for this quarter was 6.31 billion. That's a 33% growth. This number is crucial for valuation because it represents the cash Visa can actually use to grow the business or return to shareholders. Now we should look at where some of that cash went, and some of that cash gets also converted into dividend. So there are many ways that free cash flow is used. One of them is dividend, and so almost it went entirely back to owners through buybacks and dividends. That's 4.83 billion in share repurchases, which is massive. Actually, let me show you some of these, which is another important one to look at, is shares outstanding. As you can see, their shares outstanding have been significantly decreasing, and that's another way of using their free cash flow is buybacks or dividends. And you can see that they have been purchasing it at an impressive rate with this trend line. So back to our cash flow, and as you can see, their dividend paid out to shareholders have been increasing as well, and nearly 5 billion returned to shareholder in just 3 months. When evaluating stocks, consistent capital returns like this is a major positive because it directly boosts per share value. So for